A TGIF from Yahoo Finance's New York City headquarters studios. I'm Yahoo Finance Executive Editor Brian Sozzi. You're watching Grayscale Investments ringing the opening bell at the New York Stock Exchange. AXG getting trading underway over at the NASDAQ. Now, a busy week for corporate earnings ends with, you guessed it, friends, more corporate earnings. Ford cutting its outlook due to a supplier fire, but I found this interesting from the earnings call last night. The company lowered its expected tariff costs this year by $1 billion to roughly $2 billion, half of which it expects to offset through actions like price increases and cost cuts. So that's some good stuff over there at Ford. Intel shares catching a bid after minor, and I mean, I can't stress this enough, minor signs of the business stabilizing. CEO Lip-Bu Tan also proudly trumpeted his high-profile new investors on the earnings call last night. That would be the U.S. government and NVIDIA. Everyone looking for a win right now. And speaking of wins, the bulls may have gotten one in this morning's much-anticipated consumer price index report. The delayed report, of course, because of the government shutdown, showed inflation running at 3% in the 12 months through September. That was slightly slower than consensus forecast for 3.1%. Let's get a check on the markets on this very busy Friday morning. Brooke DePalma is at the NASDAQ. Brooke.
Good morning, Brian. That's right. Some bullish reaction from investors this morning following that CPI print. We're seeing all three major indices open in the green this morning, led by the momentum from the NASDAQ. The NASDAQ up about 0.8% at the open, and just slightly behind, moving higher, is the S&P 500, which is currently just near record high territory. We're looking for the S&P 500 to cross 6,800 in order for this to be a record high. So we'll keep our eyes on that during today's trading session. Also, the Dow seeing some momentum as well, up about 0.5%. But I do want to take a look at something that is falling, and that is the bond market. We're seeing near-term bond yields falling this morning, down about 3 basis points when it comes to the 13-week T-bill yield. Also, the 10-year T-note seeing some downward momentum as well, down about 1 basis point, and the 30-year T-bond yield also falling as well. But something that we are seeing in the green is these home stocks. These are stocks that have really been roiled by these trade negotiations that have been underway. But this morning, we're seeing some really positive momentum at the open. Ethan Allen, Wayfair, Restoration Hardware, all up more than 2%. And also want to point out to Home Depot and Lowe's, both up about 0.3%, as investors really bake in these the expectations that the Federal Reserve will cut interest rates in October and December. And also taking a look at the NASDAQ, because we are seeing some momentum there across the board from the Mag 7, but also Intel leading the way here, up more than 5% at the open after we got that report out yesterday afternoon that beat on both the top and bottom line. We're also getting some rhetoric, 5 firms upping their price target, and right now the average price target for this stock, it's actually trading above that at $40. The average 12-month price target is still at $35, despite those 5 firms raising their price targets. You can see here lots of momentum heading into this Friday's trading session.
Crushing it, Brooke. Thank you so much. All right, here's what I'm tracking out of the block today. Bring on that next rate cut. The delayed consumer price index report, of course, because of the government shutdown, which is still not ended, showed inflation running at 3% in the 12 months through September. That was slightly slower than consensus forecast for 3.1%. The results likely set the stage for another rate cut from the Fed when they decide on rates next Wednesday. And the earnings season of surprises keeps on keeping on. Intel showed some signs of life in the third quarter, barely. Ford's business held up well, similar to what GM CFO Paul Jacobson told me about his auto business earlier in the week. And Tidemaker P&G surprised a worried Wall Street with an 11-cent earnings beat. Not bad there, folks. All right, here in the opening bid roundtable, LPL Financial Chief Technical Strategist Adam Turnquist and Yahoo Finance Senior Reporters Brooke DePalma and Inez Ferre. Adam, let me start with you here. This report, or the CPI report that we finally got, what's the read-through to the Fed next week? The market seems to think we're getting a 25 basis point rate cut, but is that signed, sealed, and delivered?
I think with today's CPI report, it definitely is. It's the green light for the Fed if they needed further evidence for a rate cut. That's what the market is pricing in as well. Right now, the market, though, pricing in 5 cuts by the end of next year. The Fed just told us in September, look, 2 more this year, maybe 1 next year. So there is a gap between the market expectations and what the Fed's telling us. That gap tends to be a source of volatility. Of course, we'll see what the Fed has to say next week in terms of their outlook. Has it changed really since the September FOMC meeting?
Adam, look, if we're going to get all these rate cuts, is the reality just this? It is hard to not buy dips in the market.
Right now, I think we're at a fine line in terms of where rates are, where expectations are, because if we start pricing in more rate cuts and the Fed becomes incrementally more dovish, you have to ask yourself why. And it's not because economic growth is getting better. It's because they're seeing maybe more signs of a slowdown. How long can that last in terms of buying the dip? We think if we start to see those rate cuts get priced in and the Fed turn that, be really more dovish, I think recession fears are going to percolate pretty quick. Now, that's not our base case, but we do see that as a risk, especially when you look at the trends in the fixed income market. We have the long bond moving lower, 10-year yields moving lower, below 4%. To us, that's a sign maybe the fixed income market is pricing in a little bit of a slower growth outlook than maybe the equity market is looking at.
Brooke, not everything in this CPI report was roses. I get the headline, I get the market response, but you dig into it, a power price is starting to pick up, likely because of tariffs. You even had some food areas also pick up. The meat and poultry index and eggs that were up, I believe, 5% or close to that. I got Julie Hyman complaining about the price of beef tenderloin in her show. There's a lot going on. I mean, it's not exactly deflationary out there.
Yeah, there are some pockets where we are still seeing inflationary pressure, especially around that beef and veal category. It's up more than nearly 15% year over year. And that's really led by uncooked beef roast. That specifically was up about 18%. And that's really based upon this demand, this lack of inventory of these cattle, and really the struggle that right now ranchers are going through. And ultimately, that's what's driving up prices when you think about weather implications, when you think about the lack of inventory, and really the need to rebuild this flock, or essentially this supply of cattle. And so that's really has been a stubborn point. We've heard this throughout the past months when it comes to beef and veal, but food at home at large was up about 2.7%. And in the last month, that was up about 0.3%. So clearly, we are still seeing this inflation around those grocery costs. Also, apparel was up. That's something that had been ticking up slowly, but it's not up tremendously based upon the implications of different executives and sources that I've spoken to, the fear that was really baked in back in April about what exactly this can mean for prices. But of course, something that all Americans are facing is really those rising energy costs as well.
Brooke, the CPI calls out veal prices?
Brian, you got to dig through the numbers. Of course.
That's why I came to you, because that's why you are
beef steaks.
All
the different kinds.
You're our chief egg correspondent, but that's veal. And as I've had a piece of veal in about 15 years, so this was a little bit of a news to me. But look, I mean, the market has settled on this view. We're going to get more rate cuts, and like we just talking to, like Adam just mentioned, it's going to be hard to lighten the load in one's portfolio, given we might get 5 or 6 rate cuts over the next 6 to 12 months.
Right, and that's why you're seeing the markets near record territory right now. It's because, is it because of FOMO? I mean, look, the market is expecting rate cuts this year, 2 rate cuts this year, at least more, as you just mentioned. And when it is seeing that, investors don't want to sort of lose out on this. What I take away from this CPI print is that, yes, it came in better than expected, but you still have annual CPI at 3%. That's still not what the Fed wants. But obviously, if the Fed is going to be cutting, it's doing it because of the labor side of the mandate. But the question is 3% the new 2% going forward? I know that is not what the Fed says, that they still want that 2% target. But nevertheless, you are seeing this sort of inflation that is still not where they want it to be.
Inez, let me stay with you here because I want to talk a little bit of earnings. Intel is top of mind for me. Stock is getting a pop on those results. And look, this is a company very much in some form of turnaround. Unclear what the end game is. And it's a tricky story really to dissect because Intel could have come out last night, reported an absolutely horrible quarter. They still have the U.S. government as a major investor. They have NVIDIA as a major investor. But let's be clear, Intel is nowhere near NVIDIA. They're nowhere near AMD in terms of product. I mean, they're totally different companies.
They are totally different companies, but they are backed by the U.S. government, and they are also backed by NVIDIA now. And this is now become sort of a theme with companies that are sort of tapped by the government. When the government takes a stake in them, investors like that. I mean, take a look at Intel year to date. That stock is up 100%. That's incredible for a stock that had been sort of floundering. I mean, for years, you talked about Intel quite a bit. This is the sort of turnaround story of Intel. Well, it has a ways to go, of course. The foundry business has a ways to go. But nevertheless, this is the market betting on, if the government is taking a stake in this, then I want to be in that.
And Al, let me get back to you on Intel. I mean, to Inez's point, stock's been on a tear this year. In part because they've fired thousands of people, which improves their bottom line. You have government involved now, you have NVIDIA involved. Why sell Intel? And I bring that up because if you're backed by the government, you're backed by NVIDIA, really the two most important forces in technology right now. It's a pretty good story to pitch. Adam, go ahead.
Going to me? Sorry.
Yeah.
Oh, sorry. I missed that part. I mean, look at the charts. It was left for dead as early as this summer. August, or late July, the stock trading around 19. It's doubled. So it's got caught up in this momentum trade. I think technically you can make the case we could revisit the prior highs around 50. I'm certainly, when you see these type of breakouts from a major bottom, they tend to be more durable. We're taking out several key resistance levels. So I don't necessarily, the technicals aren't telling you to tell it here or to sell it here. They're really telling you that there's probably some more upside, again, maybe to that $50 area of resistance here for Intel.
Adam, what chart do you like better here, Intel or NVIDIA?
That's a tough one because NVIDIA has kind of been stuck in a consolidation range. It had this brief breakout, then it went back into the range. But it's hard to argue with the longer-term trend of NVIDIA. So I'd probably go with that on a longer-term play, and then on a shorter-term tactical trade, I do think there's some upside here for Intel. At least that's what the technicals are telling us.
Brooke, last word to you. We're going to run soon my interview with P&G CEO, but I've been really surprised by these consumer results. Coca-Cola, they beat. PepsiCo, decent quarter. P&G came out here and beat by 11 cents despite various consumer pressures. Like, these companies seem to be withstanding consumer pressures and tariffs a lot better than folks thought.
Brian, that's exactly been the narrative that we've heard from so many companies, including, say, a company like Nike, a company like Levi's, and the latest is P&G. They said that they reduced their annual tariff cost estimate to about $400 million after tax, whereas they previously thought they forecasted an $800 million headwind back in July. And that's the sort of rhetoric that we've been hearing, that these tariffs are less of a headwind than analysts and the street initially had projected. And that's why we're seeing some relief when it comes to these stocks. We're seeing positive investor reaction following these results, when they were getting these better than feared results. But I do want to point out that even though right now we're hearing that things seem to have been mitigated, that things are going well, then on the flip side, we're also getting rhetoric from, say, a Goldman Sachs that says about 55% of the tariff impact will eventually be passed on to the consumer. And so it really is this sort of two tales that we're hearing from these companies, but also eventually this eventual impact that consumers will feel. And so really just trying to read through the tea leaves here of if this will actually hit, and if this will eventually show up, the CPI prints, and also maybe some consumer pullback should these companies have to raise prices post-holiday season. So
many leaves to read through. All right, big thanks to my opening bid roundtable. Appreciate it. Coming up, it's big interview morning here on Opening Bid. We'll be chatting with the CEOs of P&G and T-Mobile after the break. My stock of the day is none other than Tide maker P&G. The company is out with a really strong quarter, though one that did show some signs of a challenged U.S. consumer. I caught up, as always, with P&G CEO Jon Moeller. I will note Moeller is handing the CEO reins to Shailesh Jejurikar on January 1st, so this is Moeller's final earnings day as CEO.
Well, I honestly think that caution is warranted, not only for the quarter that was just completed, but the quarters ahead. And that's just based on a lot of uncertainty that exists in the minds of consumers. whether that's uncertainty regarding immigration status, employment status, what's inflation going to be, what about interest rates, reduction in remittances to countries like Mexico. And markets are slower than they were a year ago and certainly 2 years ago. But within that, as you've said, consumers continue to search for products which make a difference in their lives in categories where performance drives brand choice. And we grew organic sales for our 40th consecutive quarter. With that come the earnings that you referred to. We're on track to deliver core earnings per share growth for 10 years in a row. And the growth that we see is broad-based across categories. 8 out of 10 categories held or grew sales. 6 out of 7 regions held or grew sales. So it's tough. There's a lot of uncertainty. It's very competitive. But our innovation is carrying us through as it continues to delight consumers.
Two businesses, John, that came in strong and that were really, I think were the drivers of these results. It was the beauty business and grooming. Within those two businesses, why did they do better than, let's say, a healthcare, fabric care, and baby care?
A lot of that is the timing and sequencing of innovation. So, for example, we have big innovation that just came to market in September on fabric care, our biggest laundry upgrade in 20 years, Tide Boost. And we likely have the introduction of our new functional fiber detergent, brand new form to the market in the latter part of the year, whereas the innovation, very strong innovation in hair care and personal care occurred in the first part of the year. So that's primarily the difference that's driving the outcome.
One of the analysts I talked to, John, ahead of this quarter, they mentioned to me that you have a slew of innovation coming over the next 12 months. Outside of the detergents that you just mentioned, where else will that be?
To be announced when ready, but pretty much across the board.
Yeah, but leaning into detergents.
Leaning into all categories. When we reshaped this portfolio several years ago into 10 daily use categories where performance drive brand choice, we had a strong conviction that each of these categories would respond to innovation, communication of that innovation, solid commercial execution of that innovation. And that's a belief that we continue to test, but hold on to. So these are all very attractive categories to be in structurally. They all have the potential to growth. If you look at something like laundry scent beads and think about upside potential there, we're only in 20% of households. And within those households, load penetration is below 50%. So there's significant opportunity for growth, even in a very mature market in a relatively mature category, and that's true across the board. There are also significant opportunities to improve delight, and we're working hard to increase the execution of our strategy. One component of which is increasing delight in an integrated way across the 5 vectors of superiority: product, package, communication, go-to-market, and value. And obviously, those all go together and work together, and when we get them all right, the world changes.
Another industrial giant, John, Ford came out last night, lowered how much their profits will be hurt this year because of tariffs. I think they cut it by $1 billion. And within that billion, they are cutting costs, raising prices to even offset that $1 billion. Have you been able to fully offset tariffs in your business?
Generally, yes. The picture has improved, and we're doing the things that you mentioned. We're reducing costs. There's a modest amount of pricing that goes along with that. But generally, things are in decent shape.
I believe P&G announced a little while back price increases on 25% of the portfolio. What has been the response from consumers to that?
The pricing that we are taking is just hitting the market. It hit the market in September, so it's a little bit early to see the total response to that. But I don't expect it to be significant because we've combined that pricing with the introduction of some of the innovation we were talking about earlier, so that ideally, and it's certainly our intent, value as perceived by the consumer, as received by the consumer, actually increases, not decreases. And that's been part of our fundamental business model for over 185 years. Pricing has been a component of our top line growth for each of the last, I think, 20 years, and pretty much every quarter. So it's not above, if you will, kind of normal levels of pricing that are supported by very strong innovation, which is value accretive and actually contributes to consumer delight.
John Mueller has done it all. P&G COO, CFO, and now outgoing CEO. All right, in today's Power Players segment, I welcome on incoming T-Mobile CEO Srini Gopalan. Srini takes over from longtime CEO Mike Sievert on November 1st. His mandate, keep the T-Mobile growth machine humming along, just as its two large rivals aim to stop him.
Well, look, I'm really excited about taking over November 1st, but the reality is I've been associated with this business for a long, long time right now, really familiar with it, and really looking forward to kind of taking us to the next step on the Un-carrier. It's what we call unleashing the Un-carrier, and that's really about widening our differentiation. Because, you know, this huge success story that the Un-carrier has been built on, for most of our time, that differentiation has been because we've offered great value and a great experience. Now, we have America's #1 network. And so our differentiation is going to go from being based on value to being based on value, network, and experience. And so at the heart of it, there are no trade-offs at T-Mobile. Whether you want value, experience, or network, there's only one place to be at.
So when I was starting my career, I covered the tail end of John Lesure's CEO tenureship. Mike Sievert I've covered from bookend to bookend. They've been outspoken leaders in this industry. Is that the path you will take as a leader?
Look, my focus is on really driving our differentiation, and outspoken is about stating what we have and making it clear that every American knows that there's only one place where there are no trade-offs. So the path I'm on is unleashing the Un-carrier. It's building on everything that John and Mike have built, which is a fabulous company, and really driving it to the next level.
I get the sense that you're going to be focused early on, not only maintaining momentum in the wireless business, but for fiber, and expanding upon this industry theme of conversions. Like, what are some of your early focus points going to be?
So early focus, three big things. Network differentiation. We've got the best network. We want every American to know that. Digital transformation, which is just making it easy for people to buy their wireless, making it easy for people to service their wireless. I often say this, it's a bizarre contradiction. But you know, we use our mobile phone to buy everything except the mobile phone itself. That's got to end, right? We've got to make this industry live in 2025, not in 2002. The way mobile transactions and wireless transactions are done feels like it's from 20 years ago.
Well, how do you change it?
You change that by using digital capabilities, by using AI, right? You bring those things to bear and you work with customers and your employees to make that transition. And the third piece is something you referred to in passing there, which is not just fiber, but broadband more broadly, and we can talk about that. But those are the three big focus areas.
I want to get into this quarter too, but sure. They're also, you know, the folks that came before you, they've made some very big acquisitions. Will that be in your arsenal? And are there more acquisitions to be had out there to expand T-Mobile? So I think of Sprint, I think of the fiber acquisitions, you name it.
See, the way we think about acquisitions is fundamentally back to capital allocation. We've run really disciplined capital allocation. That capital allocation includes, what we start working back from. We believe the right level of leverage in this business is 2.5 times our EBITDA. And then we work back from that to say, what else can we do to drive the organic business? I've used Spectrum, for example, very similar to M&A. It goes through the same process of looking at it. We've been very open about the fact that we're open to fiber acquisitions, right? And then once we've done funding the momentum of the core business, the rest of it is shareholder remuneration. That's the way we'll think of all of it.
You've been T-Mobile putting up really good quarters for a long period of time, but this one just stuck differently to me. 1 million postpaid phone net customer adds, that was a big number. Like what was the biggest driver in that upside versus estimates?
The biggest driver is our widening differentiation. I just want to step back for a minute though. We've been the growth driver in this industry for 13 years, the Un-carrier. And this quarter, we added more new customers than ever before in our history. That's momentum. And that momentum's coming not because of kind of promotions and stuff like that. Yeah, we're competitive. But the heart of it is widening differentiation. More and more customers are realizing that you can get the best network along with best value. You don't have to trade off, right? And that's driving a lot of the momentum. What I'm really pleased about though is not just did we drive all that volume growth, our bottom line results, 6% EBITDA.
Well, that's been a huge driver of the T-Mobile stock price for a while. I mean, operating profits.
And our conversion to cash, right? And that will continue to drive us.
I want to get your take on some comments. One of your competitors came on a couple hours ago, AT&T COO Jeff McElfresh, and I haven't talked to him in a while, but he came on, and these are his words, not mine. He said T-Mobile has, quote, been deceptive on pricing. What would you say to that?
Well, that's interesting coming from an incumbent.
And I'm not used to hearing this from AT&T. I mean, usually they say nothing at all.
I can only believe that that's because of some of the pressure they're under. Look, the reality is we've always prided ourselves on changing the industry for the good of the customer. And that includes transparency in how we price. In the end, the best reflection of all of this is not us calling each other different things in the industry, right? That's not the game we play. We look at what is customer satisfaction. We look at what is NPS. We have an industry-leading NPS. That doesn't come with lack of transparency. That comes with transparency.